What kind of return can you expect if you invest now in the high-priced Amazon? This question I want to answer in this video. And with that, welcome back to Investing for Generations, your channel for high-quality stock research for long-term value investors. And first of all, I want to say thank you to my first 396 subscribers. That's amazing. I'm overwhelmed by that. When I started this channel, this was just for educational reasons for my daughter. But now we almost reach 400 subscribers, and that's just great. And if you like the video and if you find some value in this video, just please give me a big thumbs up, subscribe to the channel, and ring the notification bell to never miss another video. Because you help my little channel so much with that, and this is also a high motivation for myself just to continue these high quality stock researches. And of course this takes also a lot of time of research and doing these videos. And so if you find any value of that or just enjoy it, give me a big thumbs up and subscribe to the channel. Thank you. So in one of my later videos, I calculated the intrinsic value of Amazon, and I came to the conclusion that even with these high growth rates of 36% over the next 10 years, which is an estimate by Yahoo Finance, the intrinsic value of Amazon is around $2,300 with an expected return of 12% or a discount rate. This is just the return I expect from my investments. And so if you calculate that, you come to intrinsic value of $2,374, which was at the time of the video overvaluation of almost 40% to the then current price of $3,294. And so for me, Amazon at this point and even now is not an investment I like. But this not necessarily mean that you can't make a good return with Amazon even over the long term. And I want to try to explain why, and I also want to try to explain what can you expect if you invest right now at these high prices. Because even if you invest with this sky high prices and high quality businesses, and Amazon for sure is a high quality business, you still can make a good return, maybe not 12% as is my expected return of my investments, but at least with so much money in the market. And here we just see the balance sheet of the Fed from September 2020, and we see there the balance sheet goes up to $7 trillion right now, and just make a big jump here in 2020 with the pandemic situation. There's so much money in the market that of course also the stock markets can go up even higher from this already very high prices. And on the other side, we have the US 10-year Treasury bonds at a historic low. And so, of course, when you invest, it's always to look what can you get for your money and what's the risk. And of course, the US 10-year Treasury bonds are almost risk-free, but right now you get here a return of only 0.7851. And that's of course almost nothing, and after inflation it should be a negative return. And of course, as an investor, that can't be the goal to get a negative return. And so we have to look for other investments, and of course the stock market is one of that. Maybe another thing is real estate, but that's another point. Here we're talking about the stock market, and so we have to look for good investments at least that beat these risk-free investment bonds by quite a bit. And that's the goal of long-term investment, of course, to find the right ratio between risk and reward and a good return. And as I said, of course, with Amazon, we have a wonderful business. I explained that even more in my depth in video about Amazon, depth in analysis about Amazon. And so there is no doubt this is a great business and it will be also in the foreseeing future. I have no doubt about that. Don't get me wrong, when I talk sometimes a little bit skeptical even about the best businesses in the world. It's just my view of an investor and the risk and reward. And so, of course, Amazon is great after all. But what can you really expect as a return at these high prices? Amazon right now have a market capitalization of $1.5 trillion. Just the number is incredible, insane. With a P ratio of 120. The P ratio of 120, of course, also looks very, very expensive, and I guess it is. But with a growth stock like Amazon, the P ratio is just 1 point to view at. And so we can make the calculation, and I just put in the same growth rates as in my originally intrinsic value video of 36% over the first 10 years of growth and 8% over the second 10 years of 8% because no business will grow forever. And with the current price of 3,142, we would have a discount rate of 9.5% to just come to an equal intrinsic value. So this means 9.5% would be your expected return over the long term if you invest in Amazon right now. And of course, remember the 10-year treasury bonds are under 1%. Here, the expected return is 9.5%, so this is way more. And so, of course, even Amazon can be a good investment, at least if you compare it to the risk-free treasury bonds. Um, and so, of course, it can make even sense to invest right now, even at these high prices. But there is a big risk with these growth stocks, even if you have great businesses like Amazon, Apple, and so on, because when you make these calculation and you think about that maybe the growth rate in the first 10 years is not 36%, just 30, which is still incredible high over a long term of 10 years, then you just had an expected return of 6% to come to the intrinsic value of the current price, or even almost. And then, of course, 6%, it's still higher than the treasury bonds, but the investment in stocks have a kind of risk, even with great businesses like Amazon. And then you have to think about, is 6% enough for you to take this risk over the long term? And of course, if Amazon hasn't a growth rate of 30% or maybe just 25, then the expected return would also lower. And this is, at the end, just risk and reward, and everybody have to decide by themselves what kind of risk you want to take and what kind of reward you expect of your investments. And also think about, in all of these calculations, the intrinsic value or even the expected returns right now, there's never a margin of safety in these calculations. So if you are wrong with your calculations, your return will be even lower or even negative if you're totally wrong. So my goal is on this channel, and this is what I try to explain in my videos, what I want is, in the first place, I need a good, even better, a great business like Amazon is, for sure, no doubt. But then I also need a reasonable price with an expected return of at least 12%. This is my expected return. And then I need a price under their intrinsic value and way under the intrinsic value. This means at least 10 to 20% normally. With these very great businesses like Amazon or Apple, I would be happy just to have skin in the game if I can get these companies at the intrinsic value. But this is just an exception. With all the other businesses I have, I want to buy them way under the intrinsic value, and you can see this systematic when you look in my portfolio. Up here on the screen is a link to my channel where you can find depth in analysis of all of my positions in my portfolio, and you can find this systematic all over the place. When you have a margin of safety, when you buy way under the intrinsic value, this is really a safety because I'm not a genius. I'm not an investment advisor. I'm just a random guy talking here on YouTube. And so I need a margin of safety just to sleep well and hopefully get a reasonable return over time. And that's, of course, the goal for all of us. And with that, just take my weekly look into my portfolio. And first of all, I want to go through the dividends I got in the last week. First of all, I got from Travelers $17.36. From Coca-Cola, I got $15.68. From Imperial Oil, $16.31. And from PPL Corporation, $26.45. So there came some dividends in the last week, and that's nice to have a small cash flow, even if it's just small numbers, a small amount of money. And then in the last week, I also bought 3 more shares of Chevron. As I said in one of my videos before, Chevron, as also Imperial or oil stocks, just dipped again with the low oil prices. And so I took this chance and bought 3 more shares for $70.53 on October the 1st. And with that, my portfolio just looks like that now. The Chevron stake just a little bit higher now. It's 3.7% of my whole portfolio, or 36 shares already. And as I said before, you can find a deeper analysis of all of these businesses on my channel, and also with a calculation of the intrinsic value and an explanation why I think these are great long-term investments. And that's all about on this channel. It's all about the long term. This is not for speculation. This is just for investment and investment in businesses, not in stocks. That's a big difference, of course. And last but not least, like every week, just take a look at the overall performance of my portfolio. As my subscribers already know, I started this portfolio at the 2nd of December 2019, and since then my portfolio has a performance of 22.51% compared to the S&P 500 of 9.33% in the same time span. And so this is a nice outperformance to the whole market, and I'm very happy about that, of course, and we will see how this will work out over the long term. And that's it for today. If you liked the video, give me a big thumbs up, subscribe to the channel and ring the notification bell to never miss another video. And then we will see the next time, then hopefully with 400 subscribers or more, and with another analysis of another stock out of my watch list. See you then. Take care. Bye bye.